Good afternoon, everybody. Welcome to the TraderMerlin show. It is are we Tuesday? Yep, we're Tuesday. I forget because I have a class this evening. I always lose track of time over there. But it's your Tuesday afternoon edition. Hope you all had a fantastic trading day out there. I picked the wrong day to get out of all my put positions, huh? You saw a nice little market sell-off there. And, well, we'll see how it all transpires over the next couple days. And I'll let you know more about some of my positions as we go forward. But let's talk about the end of the year. As we know, we are quickly approaching the end of 2022, and a lot of people just sit idly by and let their market do what it needs to do, and they don't really do much planning. And as I've emphasized over the past couple of months, planning is probably one of the most important things you can do, not only from a specific trade perspective, but building out your business plan as a trader. And of course, that also means planning for the year end, because there are definitive things that end and you can no longer take advantage of once this year ends, and there are some milestones as well. So I thought we'd talk about that today. We're going to talk about end of year planning. My guest joining me from the East Coast today, we've got Mr. Justin Krebs joining us. Justin, how you doing, my friend?
Hey, Merlin. Good to see you again, man.
Good to see you. It's been I think it's been a month. We'll probably have the monthly session with you and I. How you been?
Been great, man. Good, just living the dream, getting puppies and all that kind of good stuff. So
the end of your puppy, aren't you supposed to put a bow on your puppy and deliver that for the holidays? I mean, you're a little bit early.
No. So my family said it was my Christmas present.
Oh. So
yeah. That's got kind of somehow a stretch. I think that's kind of a little bit white lie for them, but yeah, new puppy in the house now. So
nice. Well, congratulations. I'll probably hear some random yipping in the background, right, or biting your ankles as you're doing the show.
Probably.
All right. Let's shift over to the discussion du jour, which is end of year planning. And I left out the word retirement or tax because I wanted to kind of do more of an umbrella approach to it. As we look at this end of year, which is quickly approaching, generally with a market that's going to be down 20%, there's a lot of people out there carrying losses. They might be in the wrong positions. What would be some maybe checklist items that you can look to and maybe recommend for end of year tax planning or retirement planning for people in their long-term accounts?
Well, I mean, that's a great question. And it's, it is planning. Retirement planning is always very kind of, I say, personal, because it's customized to the individual. There's no kind of blanket advice that you can really give. But basically, let's try to break this down between the basically people approaching retirement that are over 59 and a half and the folks that are before 59 and a half. So let's start with the people that are still working and below 59 and a half. Well, if you're below 59 and a half, obviously at the end of the year, and I see this with a lot of clients that have come to me that own businesses. So if you own your business out there, which I know that we met a lot, like at OTA and stuff of that nature, where you have a lot of folks coming in that are, have their own businesses and stuff like that. What I find with those folks is that they always forget to kind of pay themselves,
right?
Putting away money into retirement plans. So if you're able to, I think the end of the year, just before the end of the year, is a really good time to say, hey, you know what? The business has done okay. It's done well. Let's max out what we can, as much as we can, on the retirement side of things, on the, if it's a SEP IRA, if it's, whatever type of retirement plan that you have, it's a good idea that, I own my own business too. So it's sometimes it's always easy for me to even forget as well as a financial planner going, oh, okay, yeah. And that's why I kind of go through these things at the end of the year. So maximizing those retirement plans.
And I think before I let you move on from that, and you say maximizing retirement plans, there's obviously multiple vehicles that we can choose from, and you went with SEPs, which might be, I would say, maybe a little more advanced. The generic ones out there, you're looking at your traditional IRA, your Roth IRA, or your 401k, and I'm a believer that if your company matches, you should be always maxing out your 401k. With your IRA, I think the contribution limits that's here are $6,000 for IRAs. That's traditional and Roth. $7,000 if you're over 50. It's important for everyone to think about that from the perspective of that's $6,000 that I may be able to take off of my tax liability, depending on which IRA I put that money into. And it becomes a broader discussion of tax planning, which we're not going to do here. We're not CFP or we're not CPAs. All these three-letter
CPAs.
acronyms are confusing me for a second. But certainly I would take a look at those IRA contributions. If you're making over a certain amount, you can't contribute to a Roth, but you can do to traditional. So that would be a great end-of-year taxing. And most people probably don't contribute to their IRA on a regular basis. They forget about it until it's a little too late.
Yeah, no, agreed. So if you're in an employer's plan of obviously a 401k, then you're probably already trying to max it out. And at the very least, you should get the match. And this is where the question of taxes actually come into play. So many people are always putting away money to try to save on taxes this year, when in my opinion, most people are going to see a greater tax burden down the road, because the largest, basically the largest source of tax revenue for, to hit America is going to be in your IRAs, your tax deferred accounts. So number one, what I would do, and this is my recommendation to and my clients that are still working and that are, under the age of 59 and a half, I always tell them, look, if you work for a very large employer, now a large employer is 500 employees or more, go to them. People don't know this, but over 80% of large employers actually have a Roth 401k option, right? Which is fantastic, because Roth IRAs have limitations to them. Roth 401ks have limitations to them as well, but the limit is comparable to a regular 401k. So the ability to put away a lot more money into a tax-free accounts, because remember, any kind of Roth type accounts like that, they accumulate tax-free for the rest of your life. And the beautiful thing about this, people don't think about this, is they're also free of the required minimum distributions. Right. And people are like, what are those? That's something that will get you in trouble when you're 72. But people never think about it until they're in their 70s, and they go, oh, wait, so my IRAs, my 401ks, all this tax deferred money that I put away that has grown to this huge amount, I'm now required to pull that money out by the IRS. Oh, and all of that's going to be taxed. So it really penalizes the savers, because a lot of folks, and I see this all the time, think about like a $2 million IRA account, tax deferred. You haven't paid taxes on it because that's you put it away thinking, hey, I'm saving taxes now, right, for the long haul. But then you hit age 72, the IRS says, hey, that money, I don't even care if you don't need to touch it or don't want it, you're going to have to start pulling that out. Right. So they make you pull it out close to about 4% in the first year. If you have a $2 million account, that's an extra 80 grand of income that now counts towards your taxes, right? Yep. And then what happens is that goes up every year. So by the mid 80s, you're pulling out six figures. You're pulling out six figures that you're going to have to deal with the tax consequences on. So people don't really understand the tax consequences of those things. And I would tell people, if you're 30s or 40s, if your employer offers that Roth 401k version, go for it. Yeah. I know you're not going to save as much on taxes in that individual year, but over the long haul, you're going to actually save more in taxes, and you're going to have a tax-free account and not experience the other penalties that you have by having tax deferred accounts later in life.
Yeah, and I think a large part of that comes down to kind of how you're investing and how you're allocating. I am at a point now where I realize I'm going to beat most of the markets by, instead of just holding some mutual fund that's a large cap growth, I'm probably going to beat those markets given my trading knowledge and my experience and my track record. So that's another argument for a Roth IRA, because I'm going to grow that money and I can grow it much bigger. And let's say if you have $2 million in each account, you got $2 million in a traditional and you got $2 million in a Roth, man, you hit retirement age, I can take that $2 million out of that Roth tax free.
Right.
No tax hit whatsoever. Whereas if I take that $2 million out as a lump sum from a traditional IRA, now that I'm going to be in the highest tax bracket. So these are, do you want to pay the taxes now or do you want to pay them later? Those are certainly considerations. And this was one of my projects that I did when I was in college. Actually, it was an Excel spreadsheet class. And I built out calculators to figure out at which point is a Roth IRA better than a traditional IRA. And there was only like one or two exceptions to make the traditional IRA better. And that was if you were right near the end of retirement. You're just about to retire, not end of retirement, because that would be the end of everything, but just about to retire, like a year or two away from retirement. It really didn't make too much of a difference. However, the longer time horizon you have, a Roth IRA is probably a much better option, although you do get capped. So at a certain point, if you make too much money, you can no longer contribute to a Roth IRA. But, worry about that bridge when you get there.
we actually can. That's it.
Loopholes.
There's a few things that I want to address in what you said, because
Yeah.
that's brilliant. People think that doing Roth conversions or putting money into a Roth doesn't pay off beyond a certain point, which you just showed. That's incorrect. To me, and looking at the statistics, really, like you said, if you're just at the very end of retirement and you try to do Roth conversions, you won't have the time to maybe make back what you've potentially have lost. And those are very rare situations. Or two, you were a very poor saver and you made a lot of money basically towards the end of your career. So in other words, you didn't save a whole lot, and then you were making money, so you're in a very high tax bracket before you retired, and then all of a sudden your tax bracket goes down, which leads me to point 3. If you think taxes are going to be lower in retirement, and this is the point that I bring up to people, you have an IRA, you're always on the hook when the legislature gets together and goes, hey, what should we do to make up for this huge deficit and debt that we have? You're always on the hook for those law changes. Roths aren't on the hook because you've already paid the tax on it, right? So you have that tax-free money that's also immunized you to a degree against any kind of future, what I call legislative risk. So it is all worth that idea to, if you're younger, see if you can contribute to Roths. And that's where the second point that I was going to make about what you said, you can contribute to Roths. Currently, even if you have a high income, there's 2 ways to contribute to tax-free buckets. One, you can contribute to a Roth IRA by doing what's called a backdoor Roth. So there's a backdoor Roth and there's a backdoor 1K, which you can also do. I'm not going to get into how it actually works, but it is possible to, if you make a very high income, to be able to contribute to a Roth account to have your investments in. The second is, and I'm going to say it, and people are going to roll their eyes, but there's certain types of life insurance out there that are investment type life insurance. Just to make sure everybody understands that. There's a big difference. When you think of insurance, people think of you pay premium to get the maximized death benefit, and that's how most works. That's okay, and that's fine if you are trying to insure you're 30 and you have a family. That's fine, okay. But that type of insurance is really not a very valuable asset. Other types of insurance do the opposite, where they try to get the minimum death benefit that's available, just so you can build the cash value tax-free, right? And I'm not talking about whole life, other type of index universal life, those type of investment, man, those don't have any limitations. You can put money all day long into those things, and they're a tax-free investment that builds cash value, just like any other investment would be at a high rate. They're indexed to S&P, right? And it also comes with some life insurance if you happen to need it or happen to pass away. So there's a few ways for those high earners out there to actually contribute tax-free buckets if they really want to. But again, not a lot of people kind of understand that universe out there.
Yeah, and I think, and you mentioned it, I think a lot of people, and we actually had this the other day, a lot of people, as soon as you mention annuities, everyone's like, oh, it's just a scam, it's a fee grab. And I felt that way at the beginning. And same thing with life insurance, but I think if we stop and look deeper under the hood of them, I would agree a lot of annuities, a lot of IRAs, or of life insurance is probably not needed and excessive in fees. But there are strategies out there. There are some specific tools within annuities, within life insurance, that if utilized correctly, like you say, it can backdoor you into these Roths. It can also, get you, as I mentioned on one of the viewers, it can get you to a level with an annuity, for example, where you're not taking any losses, but your gains are capped. So, who's that beneficial for? Somebody that's in retirement and doesn't want to lose their capital in their portfolio. Great, that might be something of benefit. So I think if we look at the different instruments available, you might find something that works better for you. And yeah, I'm not super familiar on all the life insurance products, but I have heard about term value life insurance and people using that capital like a retirement account, which I think is a very different thing than what life insurance sounds like, which is, hey, I die, pay somebody else.
Correct. And you're absolutely right. It's I just think the same way. I worked for many years, and when you are particular perspective of things, and it's, because you're trying to persuade people in a certain manner. So like when I was teaching, right, I wanted people to get their investments. And so anything outside of that, be it annuities, life insurance, even advisors and stuff like that, I was like, they're bad.
Yep.
Bad, 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 bad. But then when I got into this arena, and I agree, by the way, a lot of this is really sold with not good intentions, right? Most advisors aren't fiduciaries, or standard. Most of them aren't independent. So when you look at the world of what you actually get into, people are right to be very, very, suspect of the financial industry and all these different products that they hear about. But as I've gotten into this, and I got into it by really kind of helping my mom with her retirement. If you really understand the whole perspective and are to go to wherever you want, to the investments that you want to go to, man, there's great annuities. There's great types of life insurance products. There's even, I'm going to say it, even good mutual funds out there. There's great mutual funds out there.
Bite your tongue, Justin. What? You such blasphemy you speak. No, I agree with you. I agree with you.
So it's a perspective of what you get in the finance industry. You get people that have an agenda, and that's unfortunate. And we all have agendas, but when you have a guy that works at, I'll say like a big box firm, well, they're there to sell securities, right? Because they get paid off securities. When you get a guy that works at a big box insurance company, they're going to sell you annuities because that's what they get paid off of. They're going to sell you life insurance because that's what they get paid off of. Yeah. Right. I mean, and that's just the bottom line.
Yeah, and that's the problem I saw. I actually was building out some courses on life insurance and annuities, and one of the things I kept hearing was that generally, and I think it's echoed here from Lisa. Lisa says, my ex-financial advisor pushed products that paid him the best commissions. And that's generally the case. A lot of salesmen are going to sell you whatever makes them the most money. So I think, this is important when you're looking for a financial advisor, that don't look for somebody who's just trying to collect a check. It's more about, hey, what's right for my client? And this is where education comes in handy. You should know about annuities. You should know about life insurance. And if someone's going to be pitching those to you, dig through so you can ask all the right questions and put yourself in the right thing. And that may be less fees for the salesman. Fine. If it's a good salesman, it doesn't matter because he's got a client that he's going to have for life and treat them much better. So there we go. I'm going to throw one out there as far as an end of year thing that all of you should do. And this is going to kind of be maybe a little bit from left field, but having dealt with this recently with a family member, I would tell everybody to make a list of all of the accounts that you have. Write down on a piece of paper, every checking, every saving, every retirement, everything you have. And you should go into all of those and designate beneficiaries to all of those accounts. And the primary reason is, if you have brothers or sisters or family members and if a loved one dies, it goes into probate and then the bickering starts and then the fighting and feuding between family members starts. So write down in your account, hey, this account's going to go to Aunt Joni and this is going to go to Cousin Bob, and designate in all of your accounts beneficiaries to prevent big problems down the road for family members. I know it's a weird one, but that's one that I think is pretty important.
That's not weird at all. That's crucial. I work with so many people that I've even had the experience of working with a husband and wife on their retirement. And when I came down to checking their beneficiaries, because that's something that I think is part of the estate process that you should always, whether I'm not a state attorney, but I make sure everybody's accounts have the right beneficiaries to them every year. And when it came down to their house, the husband was the sole person on the house. Think about that. If the husband died, what would happen to the house? Right? Especially, and again, that potentially could be an issue, yep, right? Yep. So just having these little things is because, having the experience of people fight, that it's family always fights. And if you think, hey, my family's good, they're good, everybody's going to be fine when I pass away, I don't need to get these. That is 100% wrong. People fight over money just because it's money.
It's not even money. Jewelry, possessions, the car, the motorcycle. Yeah. It's like, it's crazy.
So yeah, I agree with you. Like, go through your accounts, go through your beneficiaries, make sure that you have everything. I had a relative pass away recently as well, and they're still looking for money that they had all over the place. So at least if you're going to hide your money, at least notate it in a safe or something like that where you have these things hidden, so that people aren't burning down the house to try to find it.
Yeah, don't burn down the house. All right, what else do you think might be critical for? Let's just stay on the retirement or investment portfolio thing. Going into the end of the year, what other considerations might be critical to think about?
Well, I mean, kind of again on we're having a down year, so this is I think more appropriate in kind of an up year, where if you have taxable type accounts, try to do some kind of tax harvesting just to reduce the exposure of your short-term capital gains. This year you have a down market, so it's not really as applicable. And I'm sure there's people that are going, well, should I just kind of lock in my gains now and carrying forward for the new year? I mean, hey, that's a personal decision that you have to conclude to yourself. I mean, everybody's different in that particular circumstance, but I would say this, even if you have the ability to do Roth conversions at this point, actually doing Roth conversions makes sense in a down market as well, because you can actually transfer the same amount of shares to a Roth right now with less, basically, at a lower cost. So on the taxable side, tax harvesting, you got to be careful in down markets, because that's just capital gains losses that you're taking forward. And if that makes sense in your particular case, well, it makes sense in your particular case. But if it's an up year, I strongly that's definitely something I think you should do. Plan towards the end of the year, take the losses on some of the stocks that are down. That way they kind of offset the capital gains in the stocks that you're up in.
Right. Let me, I actually had a question there, so I'm going to bring it up here just so I can give props to those that have asked questions. And this one was from Tim, which I think you already answered. It says, I've got a couple of large losing trades. Would you recommend selling the losses on my 2022 taxes? And I think the answer which you gave is correct, which is, look, first off, every situation is going to be different. It's going to be personalized. And I'm not a certified public accountant, so I can't give you that taxation advice. However, you should look at your gain. If you've got some monster gainers, let's say you bought Dogecoin and all of a sudden you made 1,000% rate of return in 2 weeks, and you got some other losses, you could sell those positions that you have losers on, take those losses and offset some of those gains. So it's really more of a strategic choice decision on your part. If you have no gains this year, it doesn't really do you any good to take those losses. Yes, you can carry some of it forward, but that's more of a CPA question, and every situation is going to be different there.
Exactly. No, 100% on that. Tax harvesting at the end of the year is something that you should be looking at every single year, especially if the market's up.
Lori says, can you transfer stock rather than money from an IRA to a Roth?
You can. Yeah. Again, there's still a tax consequence. You're not going to avoid the tax consequence, but yeah, you can transfer the security over to the Roth. Again, what would just happen is that you'd be responsible for the taxable, conversion on that. But yeah, you should be able to transfer the security over to the Roth.
One other thing that I like, and this is on my list of things, so it's interesting, I'm going to bounce ideas off of you with regards to portfolios and what we should be doing. Most people, I firmly believe, don't have a quote-unquote designed portfolio. I think that most people, when they're looking at their retirement, are like, oh, I bought some of these shares and I've got some mutual funds, and it is what it is. It's just going to grow over time. And as you and I know, you can pick, let's say, 4 different instruments and say it's 25% allocation into a portfolio. And by the end of the year, one position's up, it's doubled in value and one's halved its value. So now all of a sudden I have a complete imbalance. It's no longer 25% per allocation. I might have one that's 50% of my portfolio, another one that's 10. I think it's also important that you take just a little bit of time, and it doesn't need to be done by the end of the year, but at least starting out, say, okay, why don't I rebalance my portfolio, look at what I have, see what's been the big winners, and maybe reallocate some capital so I can get back to that 25-25 mix there and ride those markets going forward with kind of a fresh, more balanced slate. What's your thought on that?
No, I 100% agree. And that's actually, again, one of the things within a year-end checklist that you should have. Because, think about what the new year brings. New year brings new goals and everything like that for most people. So it should be the same for your retirement. You should sit down, you should take a look and be like, all right, what's my portfolio doing now? Do I need to rebalance it? Because yeah, I mean, if you were very heavy growth stocks this year, you got absolutely slaughtered,
Yep.
right? So, yeah, now that may be a different percentage within your portfolio. So maybe you shift, okay, well, let's rebalance this a little bit differently. Let's go heavier value or whatever that may be. A lot of big boys are in value right now. So yeah, I mean, that's something that you should be doing every year. Again, it's just like anything else. Like, people forget about this stuff. They forget to maximize their, their investments. They forget to contribute to their HSAs. They forget to rebalance these things, check their beneficiaries. These are all things that you should sit down and take a healthy look at. Even especially on the tax side as well, right? But yeah, rebalancing these things, you should do every single year, at least once a year. And I will also mention this: if you are that person that is kind of managing your own portfolio, and you know what I mean by that, right? The people that say, I manage my own portfolio, but they really don't take enough interest to actually do it the right way, then don't get into this buying and selling idea where if you're not really truly paying attention, know what you're doing, then you're probably better off just actually buying a portfolio of good companies and just rebalancing them every year and not really touching them much.
Right. Yep.
Now, on the other hand, I'm a big advocate of paying attention to what you're doing. If you know how to time the market, if you know how to, hey, let's get a little bit light here, the market's up, let's get a little bit heavier here. Okay, great. That's a different story. But again, everybody's different. And I saw so many of those people. You know what I mean?
Yes.
You know what I mean, Merlin.
Absolutely. Yeah, there's some people that just want to get rich quick and do nothing, but that's fine. I mean, good luck. I look at it as I enjoy this stuff. I mean, obviously, I wouldn't be doing a free show an hour a day, 5 days a week for the past 12 years if I didn't love trading and investing. So for me, I love this stuff, and I'll be managing my portfolio forever. To add to that, I think that a lot of people don't look at what might be what changed this year for you, right? Did you have maybe you lost your employment and now you need to create a portfolio that generates some income streams for you, or certain things happen in our lives that change what we need from our investment portfolio. So I would say you have rebalancing as one issue, but I would take a step back and look at what is your portfolio doing for you. Is it helping you achieve the number that you want during your retirement, if you're in retirement? And if you're not there yet, like I am, how does my 401ks, how do my IRAs, how are they building to put me in a position to generate a specific income stream when I retire? Because I don't look at my retirement accounts as, I have $1 million or X amount of dollars. To me, that's not the most important thing. The most important part for me is, with all the capital I have in these accounts, how can I generate a predictable rate of return and help grow that account? And during retirement, I need to generate an income stream so that I can live the lifestyle that I want. So while it may be better the more money I have in there, it's not just about the dollar amount. It's about how I allocate that capital and put it to use.
Yeah, that's, again, right on the nose, man. So really, when you're younger, having a more accumulation mindset when it comes to your portfolio, that's ideal. But then when you start to get the idea that you're 5 to 7 years from retirement, that's when that's called that window of where the sequence of returns risks come into play. Where if you get hit in that 5 to 7 year window, that can do a lot of damage to your long-term, viability of your portfolio. So 5 to 7 years from retirement, if you have this inkling that you're going to do it 5 to 7 years from now, that's when you should start to be shifting into, I don't want to say safe, but you shouldn't be riding the big waves anymore, right? You shouldn't be on those, those growth portfolios that are just, killing it. You need to start finding, again, a little bit more conservative way to go to start thinking about more preservation. And then, of course, in retirement, again, depending on your income streams in retirement, then that's when you should, if you've got plenty of income streams, then you can basically invest pretty much how you want on the conservative side. If you do need income, well, then that's when you start basically constructing your portfolio to generate more yield more consistently. Yep. So there's different stages depending on where you're at. And again, the new year is a good time to kind of reflect and look at that. Like, hey, where am I on the retirement side? Am I retired? Am I retiring next year? If I am, what am I going to get pushed into? What am I going to start to, where's the money going to come from? Where's the yield going to come from?
Yep. Good question here from Naomi. He says, will you still do it, Merlin, if you were lucky enough to win the Powerball lottery? Well, look, I would. Yes, the answer is yes, I would do it, but I wouldn't do it every single day. I would probably do it from locations as I was traveling around the world. And hey, we're broadcasting from the yacht today. It would be different, but I would certainly continue doing this show. I like having the community here. I like talking about markets, whether it's long-term, short-term, different asset classes. I don't know. I'm a fiend for the markets. Yes, I would continue to do it, even though money at that point would be no object. Who cares? I mentioned one of my things I would do if I won the lotto is I would immediately set up all these specific allocations in my portfolio. And I actually have that video if you want to check that out. It's on my YouTube channel. It says, what am I going to do if I win the lottery? I've done it twice, but I updated it for the most recent $1 billion. Unfortunately, I didn't win that lottery, so damn it. Next time. Did you play? What's that?
Did you play?
Of course. Oh yeah, absolutely. I'm not worried about throwing $100 at that lotto. If it's worth, we're over $1 billion. I mean, come on. If I personally, I have a lot of different accounts, but my favorite one is just a 1% strategy. I try to get 1 to 3% per month in that account. I've been achieving that and exceeding that over the past couple of years. So you put 100 million in that account, you're making $1 million a month. I'm pretty sure I can live off that for the rest of my life.
I mean, that could make a lot of Halloween costumes for you.
Oh yeah, I would probably hire a whole team to put together my costumes.
Dude, you'd be epic on Halloween.
Ganesh, you've got a bunch of questions here, so don't worry about the dump. I'm going to see if I can read through some of these because I saw a few come through. Ganesh says, so Ganesh asked about the wash sale rule. So yes, there is a wash sale rule in the US. If you sell a stock for a loss, so let's say you had a loss on some Apple shares and you sold that, and then 2 days later you bought it back, the IRS will look at that as a wash sale rule, and you cannot use those losses. You cannot deduct those losses. So 30 days is the limit for the wash sale rule. So if you are selling something to take that tax hit this year, wait 31 days before you buy back in on that one. Let's see what else I got here. But wouldn't you change your identity? Oh, you're talking about if I won the lotto? I would definitely change my identity. Ganesh says, if you are in a job, should you maximize your 401k before maximizing the Roth IRA? So that's an interesting question, and I have my take on it. I'm curious to get yours. Let's say I've got an employer, and they've got a 401k plan set up. Should I max that out, or should I do my self-directed IRA through, a Schwab or an E-Trade or something like that? Uh-oh. Justin froze. I noticed you've been freezing over there. It's not my end, so I have no drop frames. There he is. He's back. You there, Justin?
Yeah.
Okay.
Everything went dark for a second.
Yeah, it's skipping a little bit over there. You're freezing up a little bit. Did you hear the question?
I did not.
Okay. If you are, let's say I've got an employer, they offer a 401k program, and should I max out that first, or should I go self-directed and do, a Roth IRA or a traditional IRA self-directed? What would you recommend?
So employer plans and retirement plans are different, right? So you can do both, right? People don't understand that you can do both.
Yeah.
So here's the thing. So my opinion, long term, and especially over the next 2025 is when the tax code is likely to shift and taxes are going to go up. And that's without us doing anything. That's just what's going to happen. I think long-term taxes are going to come into play for most of the people that are listening here. So personally speaking, if you're contributing to a regular 401k and they don't have any Roth 401k possibilities, then my best advice is usually contribute up to your match, because that's 100% return, right? So contribute up to your match. And then the money that you would ordinarily contribute to that traditional plan, find a different avenue for it, whether it's now a Roth IRA, whether you're contributing to some type of life insurance, whether you just put simply money away into a trading account that you're managing on your own. The 401k is nice because of the match and because of the high limits that it actually has. But again, if you're just putting money and storing away, we always talk about in trading, don't put all your money into one basket. Don't put all your money all into one stock because of the risk inherently in that. But people do that every single day of their lives. Yep. by just consistently contributing to a 401k, 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 tax deferred, tax deferred, tax deferred. They're putting all their eggs in one basket, and that's the tax deferred basket. Where in reality, you should have it diversified as well. You should have some money in tax deferred. You should have some money in taxable. You should have some money in the tax free buckets, right?
Yep.
You should spread it out just the same. So I say get your match. And then if you are able to find other avenues for that, whether it's, again, try to find a tax-free alternative like a Roth IRA, IUL, something of that nature in which you can do that.
For those that are asking about the 401k matching, there are a lot of employers that offer a 401k that don't match. And in that situation, I think you really have to evaluate, do I want to contribute to my 401k at all? Now, in many cases, it might be that you want to contribute to your 401k because you can now save more, whereas you're capped with IRA. So your traditional IRA, $6,000 for this year, I think $6,500 next year. You're capped at how much you can put in. So if you want to sock away more money, then go to the company 401k. However, if your company matches, and let's say they match 1-to-1, and they can match whatever amount they really want. So a lot of them will do 25%, 50%. But if they do a 1-to-1 match, you are a fool if you're not taking that match. So max out whatever. So if they match 3% of whatever you put in there, put in the max that they'll do. So you want to earn that matching. It's 100% rate of return for free if they do 1-to-1 matching. So for example, there are companies out there that I know, 25% matching. So for every dollar you put in, they put in 25 cents. I'm still getting a 25% rate of return right away. Now, here's the problem. Traditionally, with 401k plans, they're going to put you in a cherry-picked basket of mutual funds that are probably higher fees than the average that you could get by going self-directed. So you are going to pay a little bit higher in fees, most likely, and there's management fees and all that type of stuff, but you're still getting that matching. So hands down, max out the 401k if they're matching, and then look at what you might want to contribute to those Roth IRAs or a traditional IRA to contribute even more, and then that would be self-directed. And you can do a lot more with those. With self-directed, you can do almost any asset class, whereas a traditional 401k, you're usually just stuck with mutual funds. They don't even offer cash. You have to go to like a money market fund or some government bond funds in those ones typically. So my weird 2 cents.
No, and it's a good 2 cents because again, all these questions are really good, but it all depends ultimately on that individual and their circumstances. Because there are some good 401k plans that actually have decent investment portfolios or mixes that they can get into. So you basically just have to look at it from a perspective of what strategically is this going to make sense. So always get your match, and then if you really need to, if you're really behind on retirement, having a 401k that has a high limit to it that you're able to contribute after 50, you contribute over 26,000 a year. That's a good option, if you're limited to the amount of money that you can contribute. But again, if you like the self-directed idea and you actually manage, then go the self-directed route. Get your match, max out remember, you can still contribute to your 401k and your IRAs. The IRAs are income limited. 401ks are just employees a sponsor plan. So you can contribute up to your max every year, no problem in that. But the IRAs are income limited. So any IRA or Roth IRA is income limited.
All right, I think we covered quite a few things. We talked about, I actually wrote some of these down. I was going to try to put a little spreadsheet up and make a little list of things we talked about. So you have obviously taking the selling losses and taking those tax benefits, but that's more of a strategic choice for you if you have some gains this year. I mentioned designate beneficiaries. To me, that is a critical one. Make sure you know where your money is going, so your family doesn't hate each other trying to figure out where this money is going to go when they go to probate. We talked about RMDs, required minimum distributions for your 401ks. It's something to pay attention to. Some people might forget that they're forced to take it, and all of a sudden they got to take this big lump. That should be something that's part of your strategic planning as well. Although most of us aren't worried about that yet. It's more of a retirement thing. We have rebalancing your portfolio, going back through and reallocating. And there was a question from Ganesh which said, if I have two stocks, let's say I start off 50-50, and I'll let you answer this one, Justin. So I've got a portfolio, I got two instruments, A and instrument B. And it was 50-50, but now it's 75% instrument A, 25% instrument B, because instrument A has just been on an absolute tear to the upside. With my new contribution that I'm making for, let's say, my IRA 401k this year, should I put it all into stock A because it's doing so well, or should I put it into stock B?
If you put in a stock A, you might have the possibility of having better performance, but you also have the risk of, again, that the single stock risk, right? So that's where rebalancing comes into play. So if it's a choice of A or B, well, maybe you rebalance it out a little bit. It's, if there's a C option, maybe you all explore the C option, but again, be wary of putting money into investments that are already doing well, because again, all you're doing is increasing the risk of that. That's what happens, right? You start putting your money into A, and then A starts to go south, right, and then B starts to rally. So again, just a smart rebalancing so that you're not avoiding like a single stock risk. But likewise, again, this is where your education comes into play. This is why you're listening to Merlin, right? Look at the chart. Right? If there's a good possibility, if it's a decent company, it's a good possibility that this is going to rally. Well, then maybe you're buying it low, right? Mm-hmm. I mean, again, it's all dependent on that situation.
Well, and typically in those long-term accounts, also, you're not in individual securities, so it's not like I've got Apple and Microsoft in there, right? We're right, protecting ourselves in long-term portfolios by allocating to bigger positions. So I might be in the S&P 500, so I have 500 securities that might bail me out there. My answer to Ganesh would be very simple. Absolutely do not put that new contribution all in security A. I would say at the end of the year, even though it's gone from 50-50 to 75-25, at the end of the year, I would sell some of position A, bring it back down to 50%, and I would make that position B up to 50%, and then I would make my new contribution evenly split. So every year I'm going to try to go back to, in this example, the 50-50 split. Now, of course, each portfolio is going to have different allocations, but the reason for that, just like Justin pointed out, you're going to have moments where, something has a huge run up and then it has a huge crash down. I mean, look at Zoom, look at some of these social media stocks. There's always this ebb and flow, and your job as a long-term investor is to mitigate the big wild swings. And if you were lucky enough to have encountered a monster rally up in one of your positions, lock it in. Lock that in, get it back to a more balanced position, because what will probably happen is stock B is about to go on a run at some point in the near future, and you'll have a bigger position in that because you bought more of it at a lower price. So there we go. That's my 2 cents.
I mean, if you look at the long-term growth rates of basically the major indexes, they're all very similar long-term, right? So keep that in mind if you're doing this for the long term versus the short term. So you're absolutely right on that.
And a quick one, I'm going to try to wrap it up. I know you got things to do. With an HSA, John asked an interesting one. He says, my company offers an HSA, but the management fees are on the high side. Do you suggest maxing the contributions?
Well, this is, who asked the question, John?
John, yeah.
So be very careful about whether it's an HSA, whether it's a health savings account, or whether it's an FSA, which is a flexible spending account. The flexible spending accounts, no. I mean, no. But the HSA, even if they have some high fees, there is no other account out there like an HSA. It gives you a tax deduction that year. The growth inside of it, you can even invest it. The growth inside of it's tax-free. And all of the distributions from that are protected and tax-free. So that 100%, if you have an HSA set up, that's the only account that you get all the benefits of all the tax buckets all in the same bucket. So even if they do have some fees associated with them, trust me, you're saving on the tax portion of it by maxing it out.
Yeah, and especially for those who are getting older and in need of much more medical attention, these are great vehicles, right? And I think
you will always need money for health, always.
Not so much in your 20s, but
yeah, and that adds to the viability of the HSA, by the way. So if you are in the position where you can fund your HSA and also have the cash flow to take care of any medical expenses now, save those receipts, because then when you get later in life, again, here it's a little tax trick. Then you get later in life, you can, at any point, you can take the receipt of what you paid for the medical bill and take it from the HSA. And that HSA is a tax-free distribution. So it doesn't count towards income anymore, right? So it's a great way to use that to your benefit, both now and in the long term.
Lisa, can anyone open and contribute to an HSA, or does that have to be through an employer?
You have to have a high deductible plan.
Okay.
So you have to have a high deductible insurance plan. Yeah.
And last one, we got to wrap things up here. Lisa says, can I make a contribution to my child's Roth? I don't believe you can because that's your income, correct? Can you like open a Roth for someone else?
Well, the kid has to have income. So now there's different types of accounts that they could set up for the kid. But no, I mean, there has to be an income source to fund a Roth.
All right. Let me.
So get your own LLC. Pay him a few dollars per year, and there you go.
Right. You pay him to do the dishes, right? You would do the garbage. There you go. Get on the salary. Make them earn that money. Not like these Newport Beach kids that get Bentleys for their 16th birthday down here in SoCal.
Yeah.
All right, we've gone over a ton. We could spend hours doing this, and maybe we can do another show on this type of stuff. We've got a lot of questions here, and I love the interaction here, but I do have to wrap things up. I'll give you a second to tell me about your website, theproactiveinvestor.com, which I've got up here. Any resources or special things you want to direct people to?
No, I mean, I'm pretty straightforward. Some of my information is on the website if you want to talk about anything that we talked about tonight, because we did focus primarily on, except for the RMDs, everything that we talked about year end was mostly geared towards somebody that's, kind of in the accumulation phase, right?
Mm-hmm.
But we could have a whole other show about the same year end, checklist for people that are close or in retirement. That'll be a different checklist, although it has some of the same stuff on there. But yeah, I mean, anybody wants to contact me, obviously my information's on the website. It doesn't matter where you are. I'm licensed everywhere. So,
nice.
Excellent.
Yeah. All right. Well, last one, just because I said it'd be a last one, but this is, I think, it'd be answered here. Joe says, aren't HSAs supposed to be redeemed or spend yearly? It is a use it or lose it type of thing, or is that just the flex?
That's the flexible spending account. Yeah. So HSA is for life, baby. For life.
Wow. Yeah. See, even I learned something. I didn't know that was for life. I thought that there was a term. I didn't think it was at the end of the year, but I thought there was a certain limit on it. So, wow. I may have to start doing the HSA then, just to load up some money there.
I'm telling you, it's worth it. I max that thing out every single year. Awesome. It's one of the best accounts, and you can invest it too. So it's one of the best accounts you can have.
Awesome. Well, hey, Justin, thank you so much for coming on and sharing some end-of-year tax planning, retirement planning with us. I appreciate all the knowledge you bring to the table, and I look forward to having you on soon. If I don't see you before the end of the year, have a happy holiday and a great new year, my friend.
Thanks, buddy. You too.
All right, take care.
All right.
Guys, that was Justin Krebs of The Proactive Investor. I put the link in the chat for anybody who would like to check that one out. I'll take my earbuds off now, but yeah, check that one out. Justin's got a lot of experience in trading. I had the opportunity to trade with him for a little while, and just a great educator. It's a great person, and he's one of those people that's looking out for the best interest of the client. So check him out. He's got some resources for you at theproactiveinvestor.com, which I just put up there, and there's his website right there. All right, let me see. Let me just wrap things up here because I'm kind of on a tight schedule. Here is your economic calendar. Earnings-wise for tomorrow, there's really nothing that exciting except GameStop at GME. You guys know we're poking fun at that one for years now since the meme stock craze. I will show you a chart of GameStop right now just to add the fun. GameStop looks pretty much dead. I mean, honestly, since September, it's literally done nothing, bounced back and forth in a very tight sideways action. But it's drifting lower. So my guess is you're probably going to see an ugly showing from GameStop as it goes the way of the dodo, as we've talked about on this program. I'd love to see a list of all the little Reddit traders who bought this thing over at $120. Of course, that was after a split. It's since done a split on this bad by 4-for-1. Jeez, I'm crazy security. Anyway, economic analysis for tomorrow, a little bit better. There are a few interesting ones, specifically coming from the currency market. So the Canadian market will be coming out with a rate announcement tomorrow. You can see that the CAD, the Bank of Canada rate statement, happening at 10 a.m. Let me make sure I got my timings right. This should be 10 a.m. Eastern Standard Time. They're expecting a 50 basis point increase, and we've seen the Canadian dollar show some good strength lately. Here is the good weakness lately as the dollar has been gaining strength. So you can see this is the dollar against the Canadian, so this is the inverse. So as the dollar surges, that Canadian is getting weaker, and that weakness may require the Fed to step in here a little bit and try to manipulate their currency just a little bit more. On the U.S. front, we've got non-farm productivity tomorrow. You also have unit labor costs, crude oil inventories, and consumer credit. And then my guest for tomorrow We're going to have Mr. Ryan Watkins on the show to cover 2 of the trading plans that were sent in. We drew, I put pieces of paper in a hat, drew them out, and we got 2 names. So we'll do those 2 trading plan reviews tomorrow. So what we'll do is we'll kind of pick them apart, show the strengths, show the weaknesses, and hopefully can help many of you figure out how to make your own trading plan. You know, given the number of followers to this program, I was surprised to see, probably about 24 were sent in. I was actually expecting a lot more. To me, trading plan is one of the most important things you can have in your trading business because it's what dictates what you do, how you do it, when you do it. And, either you didn't want to have a trading plan reviewed or you don't have one. So maybe that should be part of your New Year's resolution is build a trading plan for 2023 and see how you can steer your path even more towards your goals of being a successful trader, whatever they want to be. All right, that's going to do it for me. I have to, I got to get out of here. Got to skedaddle. We've got a few minutes. I'm short of the hour, so it went a little bit longer than I wanted it to go today, but hopefully you learned some stuff there. I noticed we had a ton of participation from you guys, which was awesome. And if you guys have comments, questions, feedback, or things you want me to have answered, put them down below the YouTube video, or you can email me at TraderMerlin@gmail.com. Until then, happy trading, everybody. I'll see you tomorrow with Ryan Watkins talking trading plans. Take care.